I am just in awe of this audience and your ability to just self-discipline. It's really unreal. So thank you for that. I regret to inform you we've run out of our first wave of Chomp ice cream bars, so congratulations and hat tip on that one. But we will have more at the reception. And thank you to our partners at Nightingale for that. I'm not going to say too much because I know we're running behind schedule, but we're thrilled to have a full room here for a discussion on Nephila's value to the Markel platform. And I would explain ILS, but I think that might be a 45-minute diatribe that probably it wouldn't be near as good as the gentleman and lady who are about to explain it to you. So I will turn it over to the president of our insurance operations, Jeremy Noble, and he will introduce the panel from there. Thank you very much.
Okay. Good morning, everyone. Thanks so much for being here. We've had a great morning, a great set of panels so far. Even got to hear in the last panel of how Markel is a customer of CapTech, which I think has been a great partnership for us on an AI topic. We'll get into an interesting topic here today on ILS, a different acronym, if you will. I am Jeremy Noble. I'm the president of insurance for Markel. I've been with Markel almost 22 years. I've been in the current role since the start of last year, and I'm incredibly excited to be with you today. I'm joined on our panel today, first by Robin Russo, our executive vice president of insurance at the Markel group of companies. So Robin is a partner to me, and a member of the executive leadership team of our collection of insurance businesses. Robin's responsibility oversees our Office of the Chief Underwriting Officer, our claims functions, both our purchasing and selling of reinsurance, so our global reinsurance division, as well as how we purchase reinsurance, risk management, cat management, so a lot of things, and is generally just a great business partner of mine at overseeing our collection of resources across the insurance engine. Robin, much like Frank and Laura, and many of our colleagues at Markel came to us via an acquisition. So Robin was part originally of a company called Griffin, which we acquired back in 1999. And Robin now has a very long and distinguished career here at Markel, and I thank him for the partnership in that space. Frank Majors next, and I'm not going to get into too much of his background, but Frank, importantly, is a co-founder, and he's now a co-CEO and president of Nephila Holdings. And Frank's going to talk a little bit about the history of Nephila, so I'm not going to talk about his background. If you want more information, I think there's information in the bio. Frank is based in Nashville with the Nephila team we have based there. And then lastly, but not least by any stretch, Laura Taylor, who's the president of Nephila. Laura has been along the ride for building Nephila over the better part of 25 years, really almost from the beginning, and I'm sure that may come up as well. Laura is particularly involved in our primary business at Nephila, which is managing and providing property catastrophe solutions. Laura is based in Bermuda. So I'm hopeful for our session today, more than anything else, we'll give you a little bit of background about Nephila, ILS, what insurance-linked securities really are, why that sits well within the Markel Group. Most of the time will be spent on our principal business, that which is associated with property catastrophe solutions. However, hopefully time permitting, we'll talk about some of the alternative capabilities and where the ILS space is going, both for Nephila as well as the wider industry. And I think maybe the thought that I want to plant now and maybe to hold in the back of your mind is sort of the idea that Markel and Nephila are kind of focused on two areas that we think come together and create a nexus or an intersection. And one is an increasing concern around the rising level of catastrophe activity, risk generally, volatility, climate change, and what to do about that. And then also the idea that investors are looking for access to non-correlated risks to provide non-correlated returns. So you can kind of think about that, hold that thought throughout the session. We'll probably revisit that from time to time. I've got a couple conversation starters for my colleagues here. I'm hoping that we'll have enough time to open up to the audience as well and take a few questions from you all. And Frank, I think I will start with you.
Okay,
It makes sense to almost set the stage with talking about how Nephila came to be. What is ILS? What does Nephila do? And I'd love for you to talk a little bit about kind of how you and your partner and co-founder, Greg Haygood's not with us today, sort of created the idea of insurance-linked securities, and sort of educate us a little bit on that.
Okay, I'll do my best. And I do think that, and maybe the best way to understand what we are now is to kind of understand how we got here. So I'm going to go all the way back to the mid-90s. I was a youngster, and I was tangentially involved with the Chicago Board of Trade and a catastrophe product that they introduced. I don't know if anybody remembers that product. It was pretty short-lived. There was a lot of interest from the insurance industry as opening up new markets to finance what was a growing catastrophe risk that the industry was having trouble handling after Hurricane Andrew and some big catastrophes in the early 90s. That product never really took off, and I think that my takeaway from that was that investors didn't really understand the risk, so it's difficult to attract capital. So if you fast forward a few years later, in 1997 or so, investment banks started bringing out what's known as catastrophe bonds. So that was the first insurance-linked security. And that was basically where they would get somebody like Allstate or State Farm to issue a bond that would raise money that would sit in a trust. And if a pre-described catastrophe happened, they got to draw down on that capital. And if not, the investors got the capital back plus a return. So it's basically just a substitute for reinsurance. Based on the experience that Greg and I observed with the Chicago Board of Trade, we thought this product made a lot of sense. It solved a societal need, which was accessing more capital to finance the growing catastrophe risk that was, an ongoing problem. And it also provided an uncorrelated asset to investors. What we thought, there was a business in helping investors manage that risk. We thought that if somebody could go into that nexus, as Jeremy, as you described, that somebody would pay us a fee to manage that risk. And we just felt like that over time, the demand for uncorrelated assets was going to increase, and the demand for capital to finance catastrophe risk was going to increase, and that it was a niche enough, strange enough risk that there was a real value gap in what we could do for investor versus what they could do for themselves. So we launched our first fund in 1998, which was actually a pretty good time in some ways and a difficult time in other ways. It was a good time because, for those of you who remember, like the Asian contagion from the 1997, 1998, we had long-term capital management in 1998. And what those events did is they showed the interconnectivity of the global markets and things that most investors would have thought of as being diversified, emerging market equities and developed market equities. They became very correlated. So the world kind of started waking up to the fact that, yeah, maybe an uncorrelated opportunity would be good. And at that time, if somebody wanted to invest in catastrophe risk, they had to buy equity in a reinsurance company, which obviously had a lot of market beta. So in effect, our view was the industry took something that was naturally uncorrelated and financed it with equity, and in that process made it correlated. So if we could create a fund that investors could invest directly in that risk and provide expertise and access to that risk, that would be a good business. And so just quickly fast forwarding, and then shall I continue, Jeremy? Is that okay?
Well, yeah, I mean, why don't we, I think it's a great point. So, Frank, I can remember I was involved in the due diligence for Nephila. So we're back in 2018. I had just moved back from our international operations. I had just taken up the role of CFO, and we were presented the opportunity to acquire Nephila. And I remember being just very impressed with sort of the history and the track record of the business, sort of the impressive sort of capabilities. And we started thinking at that time of what the value proposition might be for Nephila to join the team. That fast forwarded, the better part of 20 years of progress and advancement and investment and expansion of those capabilities within Nephila. So maybe a great way to sort of, as we think about the coming into the Markel home, but really 20 years of progress, maybe you, Frank, and Laura would want to hear from you as well. You could talk a little bit about how the business evolved and over that sort of 20 years, what you were thinking about specifically, that brought you to the point of considering a sale of the business, and what you were thinking about as far as what you wanted to be true as relative to sort of a permanent home for the business. So sort of bring us forward from that inception and the seed of the idea to where we were sort of circa 2018.
Well, I'm going to start because I want to brag on you a little bit in this. So if you think about 1998, 1999, 2000, we just sat there and bought cat bonds. So if a cat bond got issued, we would buy it. And what we realized was that that was a very small market. So even now, the cat bond market's something like $40 billion or something like that, compared to an outstanding notional of risk in the reinsurance industry of something like $500 billion. So we felt like that our existing business model of just being a cat bond fund really limited the amount of risk we could access. And our investors were signaling to us that they weren't really interested in the bond format. They were interested in the underlying risk stream and the return associated with that. So what that meant was we wanted to go out into the reinsurance market and access risks that were trading through the traditional product, that, to round out our portfolio, to give us the more scope for growth and things like that. And so we just started to build out our platform. So today, if you walked into Nephila, we would look like a reinsurance company if you were an insurance company. We have underwriters. We act and look in a lot of ways like a reinsurance company. Now, what gets confusing, I think, to maybe our shareholders and to a lot of people is that to our investors, we look like a hedge fund. So we sort of think of ourselves as, if you travel to Europe, you take that little thing in your backpack so that your plug fits into the outlet there. And we sort of think of the reinsurance market as the UK or whatever, and I'm not sure who's who in this analogy, and the broader capital markets as the US plug, and we're that little thing in the middle. And so when insurance-linked securities, the language we use, I think, makes it more confusing than it is. It's really just reinsurance risk that we either access through buying a catastrophe bond, which is a form of insurance-linked security, or we access the risk in the reinsurance market and transform it ourselves into an insurance-linked security. And the way we do that is not that interesting. I'll be happy to answer questions if anybody has it. But what it does mean is you need a platform to do that. And that's where I wanted to brag on Laura. As we moved from a cat bond fund into basically a synthetic reinsurance company. You can think of us as a reinsurance company that finances our activities by raising temporary capital rather than permanent capital, which I think we'll get to later. You need a much more sophisticated operation. And Laura came in. We hired Laura from E&Y, I believe it was, to build that out. And that is her background, is building out all of that, what we call plumbing and operational support. And then over time, she got more and more involved on the portfolio side. And maybe you can jump into why Markel fits into that story.
Sure. Yeah, I think as we saw the market evolving and the way we were accessing risk, we were somewhat limited in our ability to offer competitive products. We still had a large investor base and a lot of way to access that risk. But we were looking to extend, a balance sheet and a partner who could help us grow into the next phase of the industry. Markel was, on the softer side, for us, Markel's reputation and track record of buying companies and understanding the value of that company and enabling that company to grow is unique. It just doesn't exist in many companies out there. We'd actually seen other managers get purchased and see that value erode. So I think that on the softer side was number one. And then I think culturally, it was just, I remember the two senior management teams met in Nashville for the first time, and it was just an instant fit. And I think it was Sue who showed us the Markel style for the first time. And the overlap of that with Nephila was just incredible. Different words, but same kind of values. So, I think Markel has that long-term thinking. It takes chances. It focuses on customer needs. And at Nephila, we had the language of thinking in terms of long-term value creation, challenging the status quo, which is something we had been doing for 20, 25 years, and solving problems is the way we focus, which comes back to Frank's point earlier.
I don't know if it's dawned on me until just now, but Alan Kirshner, I believe, gets credit for actually writing the Markel style down, if I'm not mistaken. And he's a Tennessean. Greg and I are both Tennesseans, so something about that cultural fit may have helped. I would like to add something, maybe a little bit more, to give a little bit more context about our desire to partner with Markel. Just to set the scene a little bit, at that time we were about 56% employee owned, so we had always been majority employee owned. We had minority shareholding from KKR with their own balance sheet, not in their fund, but with their own the partners' capital, and a group called Man out of the UK. You may be familiar with them. But what was happening is like we've kind of fast forwarded through the late 90s through the knots. If you looked at the market in 2000, there were probably, I'm going to guess, 15 or so monoline catastrophe reinsurance companies. There were probably, I don't know, 30 or 40 syndicates who did catastrophe in a big way. And because of the success of our business model, both us and some of the other people who do what we do, the monoline cat reinsurer just disappeared. And so the industry was really changing in a big way. And so what a lot of the reinsurers did is in 2000, you would have had, well, just us really, but in 2005, you would have had cat bond funds over here, and you would have had the reinsurance market over there. As the monoline cat reinsurers left and the specialist syndicates left, they started to try to raise money from external investors and sort of mimic our business model. And so you saw this blurring of lines, and it was very confusing to the investors who were thinking about allocating to managers. And so we've thought that there was a model that was the best of all worlds. The fiduciary and independent sort of thought leadership that we provide, but also there are certain limitations to our business model. We definitely have a lower cost of capital because we keep it uncorrelated, because we give investors their money back in 90 days, all sorts of things that lowers our cost of capital. But as part of that deal, we lose flexibility around reserving. You know, if we've got to trap capital, if we have to do certain things that are maybe beyond the scope of this conversation, but things that really equity is really, really useful for. And so if we could find a model that took the best of both those worlds, we thought that was going to be the winner. And again, coming back to Jeremy's setting the table, we do think that the demand for catastrophe protection is only going up. The society needs more capital flowing to that problem. We do think that as markets get more and more intertwined, there is going to be greater demand for uncorrelated investment opportunities. So what is the best model to sort of be in that nexus of those two things? And we think it's the combination of our traditional sort of, if we have to use the term ILS, I guess we will. I would just call it sort of non-equity capital, and combined with all of the expertise that Markel brings, and whether it's State National, whether it's Markel, you know, that's a winning combination. Now, I think we'll get to our results and that's sort of what's happened since 2018, since we did the merger. But I just think long term that it's a winning combination. And Laura spoke to why we chose Markel, but there were a lot of potential homes, and Markel was definitely the best fit. I've known Greg for almost 50 years. When Tom described Markel as a publicly traded family office, that really resonated to me. I felt like Nephila was a family thing. I was a friend with Laura for 10 years before she joined us. I mean, it's, you know, we care about each other, and we felt that was true of Markel, and we're delighted to be part of the family.
Yeah, we are happy you're part of the family as well. You know, one of the things too, Frank, that we were thinking about to build off the point, we talk a lot about the collection of insurance businesses that we have in Markel, and I sometimes reference that, or we sometimes collectively reference that as, you know, the power of the platform. So we think about this broad array of capabilities in which we can find ways to efficiently match risk and thoughtfully and strategically match risk and capital. And one of the things we liked about Nephila and sort of partnering and thinking about where the business was at that time and where we could take it. So providing more access to risk at the point of origination, providing more availability of data, thinking about liquidity solutions and how we were going to address, you know, trapped capital concerns that had plagued the ILS industry a little bit more in recent years, and it's been a topic. Access to a rated balance sheet, access to capital, more thought leaders across the organization, leverage, multi-line capabilities, which we'll touch on a little bit later. But and we've been working at those things and doing those things, and I think that's still part of the future. And again, we'll come on to some of that later. But I guess one question maybe, Frank, for you and for Laura, just building off, do you feel like relative to a lot of your competitors, we have a differentiated business model and set of capabilities now because of some of those things and sitting within that Markel home?
I think undoubtedly. Sorry, undoubtedly. I mean, frankly, part of the problem we have is simplifying our product enough to our clients, our investors, to understand all of the sort of bells and whistles that we provide. I mean, one thing that like a cat bond is it's simple. I mean, any investor can understand that. Now, to us, we also think that means that there's not a huge value gap. That's something that a lot of investors can do on their own. They can just buy a cat bond. It's not a big deal. But if you want to build out a robust portfolio that includes insurance risk that we run through State National, that has reinsurance risk from different pockets and so forth, so you've got a really robust portfolio, you know, that, and you want to have a certain liquidity profile and you want a certain amount of leverage, that's a lot of stuff to explain. So that's the good news and the bad news, you know, and I think when things are quiet, which they haven't been for a long time, you know, that really resonates with people. When there's a lot of catastrophic activity, as there has been, complexity can be your enemy in the short term. And so we're kind of working against that. But like the transaction that, I don't know that we need to go into the weeds, but that you quarterbacked where we dealt with our past years, you know, is a massive, massive win for us. Yeah. I don't know if you want to maybe spin.
Sure, yeah. So I think, you know, with, which I think maybe Robin will touch on, but the events from 2017 to 2022, one of the key focuses or barriers to entry for new capital coming in is what the industry calls trapped collateral. And that could be trapped because you know, the counterparties are trapping it, or maybe as the manager, you know, we want to ensure if people are trading, there's more certainty around the valuation of those events, and that just takes time. So, you know, with, you know, raising capital, part of the reason that the market is so dislocated and pricing is attractive is there's a resistance for capital from entering because of what they've observed broadly across the market. So we worked with Jeremy and Brian and Gunter and others at Markel to say, look, we've got this challenge because we have all these different funds and these different investor mixes. But the risk itself together is a very developed, you know, book of unfortunately losses. Is there a way we can solve this? And together we created a way of collapsing that risk into one portfolio, which allowed us to return a significant amount of capital to our investors, and then build a product that actually everyone was better off because they now owned a more diversified portfolio of ongoing risk. And we, you know, as a standalone manager, we wouldn't have been able to do that, but also none of our competitors have been able to do it either. So when we're, you know, capital's still slow to enter the market, which is fine, you know, we're comfortable with that. That's part of our model of returning capital when we need to, and you know, to build a product to attract capital back in. But that solving that problem and being able to talk investors through it is unlocking, you know, some of that capital flow to us. And we know other competitors in the market still haven't solved the problem for themselves. So real edge, real differentiation, and just as Jeremy mentioned, like the power of the platform really coming through.
Right.
Jeremy, do you mind if I add something to that?
Go ahead. Yeah.
Just as quickly as I can. Obviously, any business wants to sell more of its product, and they want to charge as much as they can for that product. Right now, you know, our assets under management are down, but with the combined product that we've worked on with Markel, our fees per unit sold is actually up. So there's been a secular decline in fees in the asset management business. So there aren't that many asset management businesses that are able to charge more. And I don't want to put you on the spot, but I mean, our effective fee rate has gone from
Slightly under 1, or I think it was 80 bips to 150.
Yeah, so we're charging a lot more for the new product. And so we just think it's a matter of time as catastrophic activity sort of normalizes, that the volume will increase and our fees are almost double what they were as a standalone product.
All right, we're going to come back to some of the things we're thinking about where we're heading. Before we do that, though, I want to pivot, and I want to sort of set the stage, Robin. I want to invite you into the conversation. So unprecedented levels of natural catastrophes that we've experienced, you know, since 2017. As you know, and you and I have spent a lot of time together talking about our thinking of how and where we put the Markel balance sheet to risk, how we were thinking as an organization about volatility around natural catastrophes was evolving. Sort of what we were observing about capital flows in and out of the ILS, in and out of the industry. So we were sort of studying that, starting in 2017 and then thinking about that more broadly once Nephila came in. But why don't you talk a little bit about our thinking in that space?
Yeah, Jeremy, yeah. So what we've heard before kind of sets this up nicely, because I'm going to talk about a use case or an example of how what occurred out there and our own internal and how we could bring those together. So as Jeremy said, starting in about 2017 for the last 5 or 6 years, we have seen significant catastrophe activity. And I'm going to use North America as an example. So we've had 5 of the largest events. We've had 4 of the worst years, and we've seen a significant increase in the frequency of $1 billion events. Many of you may be familiar with California wildfires, Harvey, Irma, and various other hurricanes that you are following along, where we've experienced those also. In addition, if you've been watching the news recently, you'll see that there's been significant tornado activity in the Midwest. So all of those activities which have occurred gave us pause and gave us an opportunity to really take a deep dive into how we present capital to the, and write reinsurance business for catastrophe and write insurance. So starting in about 17 and 18, we really took a deep dive on that. And we made a number of changes where we felt that our capital deployed to risk was better aligned. But as a result of the Nephila acquisition in 2018, it really gave us an opportunity to think about, is there a better place in the Markel platform for property catastrophe reinsurance? And in 2021, we made the decision that based off of Nephila's analytics, the expertise that they brought, the brand value they brought, and all of what Laura and Frank have been talking about, that we would move our reinsurance property catastrophe over to the Nephila platform, and that has really worked out well. While we felt we had a nice, platform in our reinsurance area to leverage that expertise, and what has resulted from that is a significant growth in the amount of property catastrophe reinsurance written in the overall Markel platform. And it has enabled us to, build fee revenue when we front. And of course, the Nephila organization had an opportunity to increase their fee revenues and potential performance fees. So that's a use case of how the insurance-linked security operation, the expertise that Nephila brought, to a real concern of ours about how we're deploying capital and where we deployed capital, and there was a solution that was a win-win-win for the organization.
Yeah, and I think it's fair to say as we were sort of examining and thinking about this space, we circled back to many of the sort of principles and tenets that we would have come to understand from the Nephila team. So the really sort of ILS being a very efficient mechanism to transfer risk from a traditional insurance balance sheet into the financial markets, the value proposition from investors to have access to non-correlated risk, really the idea of sort of market dynamics and the fact that there could be a potentially a lower sort of hurdle or return sort of requirement or cost of capital consideration, how that might influence sort of pricing or return dynamics within the space, and how we could maybe focus at Markel of where and how we deploy aggregate or PML with pertaining to sort of natural catastrophes. So we'll touch upon it in a minute, but we had a good example where we decided to consolidate our sort of focus in the property catastrophe reinsurance space under the Nephila brand in one sort of front door. But and just for a frame of reference too, when we talk about the unprecedented level of catastrophe activities, I mean, 6 of the past 7 years, we're talking about $100 billion or more globally of insured losses from natural catastrophes. From the period of, I want to say, from 2000 through 2017, I think that happened twice. So that's the level of sort of unprecedented we've been talking about. All right, so Laura, maybe we will go there. So I'll kind of pivot again, or build off of the comments that Robin was making. We recognize at Markel sort of Nephila's leadership in the property catastrophe reinsurance space. We did make that decision a few years ago to transition our traditional Markel Global Reinsurance property reinsurance operations to really give us one front door to access Markel in that space under the Nephila banner, and really have one single sort of center of excellence, if you will, one place for real thought leadership in the property cat space. And I'd love for you to give the audience a bit of a sense for kind of what that market leadership looks like, what you're thinking about and focused upon, at Nephila, and why that was a good decision for us to focus on a fee-based capital-light sort of model and the capabilities that we have within the Nephila organization.
Sure. Yes, I think we saw the events from 2017 to 2022. Quite a few. You could be sort of a generalist and put capital to work in the property cat space, but the losses and the diversity of those losses and events brought to light how complex the risk is in that asset space, and also the complexity is growing, not shrinking. And one indicators of that is the very beginning, Irma performance deviated significantly from market expectation, and there was a lot of discussion on the models and the insufficiency of the base models not evaluating that, allowing people to evaluate risk sufficiently or price sufficiently for that risk, and we were generally quite comfortable because we had been, for 25 years, we've been adjusting those models to augment it. Whether it's how the models assess landfall and what happens when the event makes landfall, through to you mentioned climate change. I mean, there's sort of climate change and long-term view there, but every year the conditions for hurricane and wildfire are different, right? It depends on if there's more rainfall in California or forecasts of when the winds pick up. And then, of course, with the Atlantic, is it La Nina, or is it the Atlantic temperature? So we, every year, adjust our view of risk for the conditions for those two perils, and then price accordingly. And that's through our research group and partners with scientists. And we spend a lot of, because that's our primary business, we spend a lot of time and focus on continuing enhancement there. Another is the data that, because in reinsurance, you're pricing a portfolio of risk. You don't have line of sight. It's more opaque. So you have to dig into the data of the underlying cedents and adjust that data or augment that data where you can. So one thing we found in Irma is, well, generally the market underperformed expectation. You did have some cedents who performed as expected and others who underperformed. I think there were maybe a couple, we saw who maybe outperformed. But our research team spent the next year or so evaluating those results and found that there was a significant correlation between claims activity and roof condition. So we engaged with an aerial imaging firm who mapped the roof condition of every house in Florida, and we were able to take that data. And now when we receive a file from a cedent, we can map the addresses in their portfolio to the roof condition and then adjust pricing or risk assessment up or down. So those are, it's the core of our business. It's where we focus the most. And, just relying on the out-of-the-box model just isn't enough these days.
Yeah, I mean, I think you're touching there on, the data and analytics, the modeling, the technology and innovation. And Frank, you might have something you want to add to this, but part of that idea of rising and increasing concerns around rising levels of catastrophe risk, right? And the concern, I think, probably from investors is how much confidence can we have around what that risk really looks like, right? And I feel like what you were touching upon, Laura, and maybe you can expand upon it further, Frank, as well, is there's a lot of thought that's gone into how do we price, that risk, and how do we think about some of these big topics that I think the property catastrophe space generally has been faced with. So increasing levels of climate change, model miss, fraud, litigation, roof conditions, right? A whole bunch of things, I think that, insured values, a whole bunch of things that weigh on the minds of investors or capital providers into the space. And I think you guys have, at Nephila, we've been trying to be really thoughtful around what that, what that's looked like. You want to talk a little bit more or build
Sure,
upon that
yeah.
idea?
I mean, again, if we start with the assumption that somebody's going to provide this service, then the question is, how do we execute so that we're the people who benefit from the nexus of those things? And we've basically sort of summed it up as three things, like, can we demonstrate that we can assess the risk effectively and price enough to generate a positive return? Can we put those risks together in a portfolio that matches an investor's appetites, not ours, but fits into how they want it to be in their portfolio? And three, can we honor the liquidity provisions of our funds? Can we get the money back to them? And we think that the organizations that demonstrate those three things the most quickly and the best will be the people who attract capital. And so one of the big things, you gave one example, is around climate change. There are others, and I think somewhere between ignoring it and hysteria is probably the right place. And it's kind of an interesting thought exercise because, I mean, ultimately it is unknowable, so we have to be careful that we're not trying to express things with precision. But so we've been coming up with a lot of sensitivity analysis, like how bad does it have to be for this not to be profitable? So just reframing the questions and being extremely transparent in how we price things. So Laura gave some examples of things some lessons learned from the industry and from us. And so our investors, as one example, gets a report every quarter that shows if you believe the models, here's what the risk is. If you adjust for fraud, here's what we think is appropriate for fraud. Here's what you would charge. And if you adjust for all these different things, if you adjust for climate, if you use a worldview of like the UN had convened a group of scientists, and there is a published report about what the world might look like in 2050 with no policy changes. We modeled that and said, if you think the 2050 conditions forecast by that group of scientists exist today, this is what you would charge. This is what we're actually able to charge. So they then when we have losses, we then disaggregate the losses and put them against those. That's an unmodeled peril, or fraud made it bigger or whatever. So they get what we call the transparency report, where we show our prediction, we show the results. Now, obviously, with catastrophes, there's a randomness to this, so you never know anything with certain, but it's enough ammunition, particularly with pricing where it is now, where the market is pricing in hysteria. I think that it's sort of like, it's landing with people in a way like, okay, now I kind of understand. So the black box was our friend until 2016. The black box is our enemy now, and transparency is our friend. So we're spending a ton of time, before having ex-ante conversations about what could possibly happen and how we're assessing the risk, and then comparing the results with that. And it's landing. We still have a ways to go to win back all the capital that we want, and we can talk a little bit about that. But that's where we're spending our time.
Great. And maybe Robin, if you want to add a point, because we kind of made that point, that consideration of transferring the property reinsurance operations from Markel Global Re under Nephila. We still obviously have a large reinsurance platform that trades in casualty and professional and specialty lines. And we think of those capabilities under a Markel banner. And of course, we have large trading relationships with many trading partners and many sort of cedents, and we try to get the benefit, I think, on both sides of the platform, Nephila as well as our other lines within reinsurance. Can you just touch upon a little bit of, how we feel like the continuity that we provided our clients and how the sort of collective capabilities is maybe viewed within the market?
Yes. So, really good point, because like Jeremy said, we have a nice reinsurance division writing professional lines, casualty lines, specialty lines. And then Nephila writes a significant amount of property cat reinsurance. So we are very intentional about going out to market, talking to the reinsurance brokers, talking to those who bring us the business about those connectivities. And in some cases, with some cedents, there's a consideration that through the Nephila platform, we're writing reinsurance, and through the Markel platform. So that's really given us some great opportunities. And without getting into premium numbers, when you put the two together, it really moves us up much higher in where we stand as a reinsurance organization. So for example, when the teams go to industry conferences, they'll be intentional where they can about connecting together with common cedents. And when we're talking to reinsurance brokers and intermediaries, we're talking about the capabilities that both of those parts bring together. So we think about it as one Markel, or the power of the platform. And that's worked out quite well. We have had some opportunities on the traditional side that have been cemented because of the relationship with Nephila.
And just to give some context to that, I mean, we are, at one point, we were the biggest catastrophe reinsurer in the world, bigger than Swiss Re, bigger than Munich Re, bigger than Ren Re, whoever you want to name. I don't know that we still are, but we're certainly in the top 5, and we're definitely in the top 3 in the U.S. So I mean, we are a big player in catastrophe reinsurance. I just didn't know if our shareholders would know that.
Yeah, and I think importantly there too, Frank, maybe just a comment to add is that size and that scale and that market leadership position that we enjoy at Nephila. I mean, the reality is that not all deals in the marketplace are done at the same terms and with the same pricing, right? And there are opportunities when you have size and scale and relationships and leadership that we can move some of those things slightly in our favor. So important maybe consideration there. Okay, I think it's going to be important. We were starting to touch upon this a little bit, but it would be pretty disingenuous, I think, for us to have this panel and not address perhaps sort of the elephant in the room, which is to discuss Nephila's, performance in the recent years and some of the challenges that the ILS sector has faced more widely. So, Frank, probably starting with you, and Laura, I'm sure you'll want to jump in as well. But I think it's worth maybe sharing, a few of the lessons learned over recent years, the things that we've been thinking about deeply at Nephila, and we were touching upon some of that earlier. Maybe you'll touch upon whether or not you see some of these as cyclical trends, whether or not you see some of these as more secular trends, what's changed, how's the thinking evolved, and most importantly, where do we feel like we're headed as a business from here?
Okay, I'll do my best. If I don't touch on all of those, just give me another prompt. But I mean, I guess when we look back, we probably need to make 2 assessments. One is as a fund manager, how did we do for our clients? And then, how did we do as officers in Nephila Capital? And what I mean by that is, if we sort of wearing the business owner's hat for a second, I would say one of the biggest mistakes that we made is we became overly reliant on one pocket of the capital markets for our capital. We really dominated the pension fund market. So if you look at our investors, it's probably 85% pension funds, mostly outside the U.S. Very strong in Europe, Japan, Australia, New Zealand. Some pension funds that are pretty sophisticated. Had some sovereign wealth funds, but mainly pension funds. And that was great. I mean, I don't know how much time you guys spend with them, but they're very different from the sort of classic Markel shareholder. They're sort of CFA playbook, like very much asset allocators and academic sort of approach. And, the non-correlated sort of story fit very well into that model. And so I think that I certainly was guilty of thinking that that would never change. And, you know, they speak in such a rational sort of approach. I sort of discounted that, well, what if all of them act in as a get scared, you know, and revisit the thesis, and that certainly has happened. So, I mean, just not by way of excuse, but, you know, pension funds have got obviously 20, 30, 40, 50-year horizon, so they think about things at the top of the house, you know, in those sorts of cycles. So one of the headwinds that we've had with our client base is that at the top of the house, the guy running the woman running the fund has said that one of their, and for pretty much all of them, one of their either number one or number two is their concerns about climate change. So, you know, we don't want to get into political debate with our clients about this stuff, but if that's one of their concerns, and then you think about the guy who is allocating capital for the alternative sleeve, he's already got a headwind because he's allocating to a strategy that looks like it's short climate change. No, it's not, and, you know, hopefully logic prevails, but with a bunch of catastrophic activity, it looks to the layman like climate change. So our transparency efforts that I talked about earlier are trying to bring logic to that conversation. But when a whole cohort of your client base, which is 85%, decides that climate change is their biggest concern and your strategy looks like it's short climate change, you're playing catch up. And so that was a mistake I wish we'd gotten ahead of, both by educating our investors a little bit better on the front end and also diversifying our client base. So what you've seen is our AUM has gone down. You know, that's been pension funds leaving, and then what's sort of replaced that, not completely, but somewhat, is more opportunistic investors, family offices, some multi-strategy hedge funds, people that can make decisions, you know, in a more timely way, in a more opportunistic way. They don't have to be so sort of institutional or corporate, maybe. And so had we not been part of Markel and be able to they want a product that looks a little bit different. I won't go into the weeds about that, but combining with Markel, we were able to put a product that, you know, we could pivot our business to attract a different investor base. So we haven't completely replaced those assets, but we are charging more fees. So it's been a little bit of a close to getting us back to where we need to be. So that was a mistake as somebody that runs a business. From managing the portfolio perspective, I mean, I think that, you know, look, we're in the business of taking people's volatility. I mean, that's the role we play for society. And the reason people pay us is to take their volatility because it's not fun. And so you know you're going to have bad days and bad years. You hope you don't have 5 straight bad years. So I think our challenge is to look in the mirror and say, how much of this is just like Mother Nature's random number generator got us this year? And that's, you know, you can't just explain the weather. And then the question is, given that that happened, did we perform as we should have? And I think for the most part, we did. You know, I think our performance is not bad considering what occurred. But we did make mistakes. Laura mentioned fraud. We definitely expected fraud. We knew there would be fraud. Even we were surprised by we charged for fraud. But we didn't tell investors we were charging for fraud. We didn't tell them how much we were charging for fraud. So when fraud happened, that just felt like it was coming out of their pocket when actually we had charged. Now, in Irma in particular, we didn't charge enough. So that would be a mistake. I think probably there were some pockets of wildfire losses that we picked up. They weren't big, you know, lose 100 basis points, but it's embarrassing. And it's not nice. So plenty of mistakes. I'd be happy to spend hours talking about them, but I would say those probably encapsulate it.
Maybe for I'll get 2 things I want to build off that, but maybe one for the avoidance of doubt around being short climate change. You might have a thought around if an investor is concerned about climate change, where might they get paid for that? Yeah. And do you think you should sort of invest in maybe a real estate fund that has coastal property?
Yeah, now I'm glad you said that. I mean, we've been trying to reframe that. It's like, well, if you're so concerned about climate change, what other markets are paying you for that? You know, we can show you what the market paid in 2016. And just to give you some level of the change here, we give a report to our investors that show them what their expected return over time is for each product. We break that down, carry losses, all that sort of stuff. And in 2016, we were showing a expected return of risk-free plus about 150 to 200 basis points, depending on the product. And we had to shut the funds to new investments. That kind of risk return profile was attracting all sorts of capital. Now we're showing a expected return, depending on the product, of something like risk-free plus 18 to 22%, and we're struggling to raise money. So it just shows how much fear, we're just like any other market. You've got fear and greed, and we are definitely in the fear phase right now. But back to your point, we can say, well, how much of that is because we've reassessed fraud? And we can allocate how much of that excess premium is some sort of implied, unexplained risk premium that we are deciding to say, you know what, this is the global capital markets fear of climate change. And so we're allocating that to that. And so we think we're getting an extra 1,400 basis points for climate change. So our argument, and it's a little bit sort of cheeky, but it gets people thinking is, well, if you're concerned about climate change, why don't you invest in something that explicitly is paying you for climate change? I don't understand why you would take money from our asset class and buy a hotel in Florida, where or real estate. And anyway, so we're just trying to turn this into a logical conversation and not an open-ended, the world's ending conversation.
I said there were two things, but that made me think of a third one, and we didn't talk about this beforehand, so we'll see where it goes. But so if I buy into that, and I think, why wouldn't I just invest in a cat bond strategy, because that seems to be very popular these days as well, and maybe I think it is worth sort of understanding some of the differentiation between cat bond markets and sort of an ILS fund that Nephila is raising, and how we think about some of the incremental maybe return proposition there.
I realize I'm talking a lot. Would
No,
you mind
you
if
go
I?
ahead.
Yeah, Mary Lauren, you're
I've got
close to
one
this
point I'll
space.
make after
Okay,
you're done.
I'm pretty passionate about this one. So cat bonds have got a certain attribute besides being bonds. They sit at the very top of the risk stack. So if you think about it, an insurance company buying reinsurance, they've got a bottom layer and a middle layer and whatever. They got a top layer, and the top is where the cat bonds sit for reasons I won't go into. And so, but they sit so high that even though we've had a lot of catastrophic activity, they haven't really been hitting many cat bonds. And so what people, when they're concerned about loss activity, those that decide to stay in the market, they show risk aversion. So they just say, well, you know what, or risk avoidance, I should say, and they hide in the top layers. So what capital has stayed in the market or that comes in the market is going into cat bonds and other top layers. So like any market, the spreads tighten there, whereas the bottom and middle layers is starved of capital. So we're seeing the spreads widen in a big way. So that's why we said the second point of the things, are we putting the portfolios together in the way they want? It's not economically logical that if you're taking cat risk that you would do the top layers, but it's emotionally logical. If you work at a pension fund, you might want to do that. So we've developed a whole matrix to help people understand what their risk appetite for these things are. And more importantly, we've given these people who are open to taking these other risks an explicit reward for taking that extra risk beyond the risk that they're taking. And so we develop a policy statement for an investor and say, if this sort of mispricing in this level is only 100 basis points more than at the top level, I'll just stay in the top. It's not worth it. But at 400 basis points, start shifting it, and with a maximum allocation to the risky layers at an 800 basis point or whatever the numbers are. So the important thing is we built a framework for us to implement their wishes. And so that comes back to us thinking of us not as a passive seller of cover or a cat bond fund. We think that we're a hedge fund who's trying to exploit mispricing of risk in a very opaque market. I mean, if you can believe that hedge funds can add value in, liquid New York Stock Exchange stocks, it seems pretty obvious that in an opaque, hard to access, difficult to understand market, that hedge fund could add a lot of value. And so that's what we're trying to do and explain how we do that to our investors. And it's been tough. I mean, but again, we tell our employees all the time, if you're not willing to endure the pain of taking other people's pain off of we don't have any other purpose. And so that's just part of the process. It's inherent in the business model, particularly when you promise to give their money back in 90 days. So if they get scared, they can go. So, education and transparency is our best fight against that, and good thought leadership and logic. I'm sorry, Laura.
No.
I give you...
That's just the only addition to that I would say is we were surprised, I think, by some of our investors' reaction to certain events. So they were, if we're saying we can show you we performed as expected in Ian, but they're from Hurricane Ian, but they are surprised by the performance of the fund. then we haven't done our job up front as well. So with that matrix and kind of talking about trade-offs of, the more out of the money you are, the less money you make. If you move down here, you can capture that extra 1,400 basis points. We're also showing them like less than a curve of like a return curve. We're showing them like this is what you should expect in a Cat 3 hitting Florida, kind of event. This is what you should expect if there's an earthquake in Turkey, and running through those scenarios with them and gauging their reaction to it, because that's where the emotion comes in. And it's also where the most of their questions, so you think of an allocator, he reports into a committee who reports into, whatever, he or she, they get phone calls from the top person. Hey, I see this flood happened or a mudslide happened in California. What's our exposure? The more we arm those individuals with that up front, they don't have to call us. They can answer that and answer it with confidence. So just making sure they understand the touch and feel of the portfolio, not just on a probabilistic basis, but a more experienced, kind of based approach.
Great. All right, I want to be sensitive to time, so I want to move us on. I kind of mentioned at the start, it's clear from the conversation, our core business, obviously, in Nephila is around the property